150,000 Ghana. Yeah, well, let's say 150,000 cedis. Charcoal grill, 80,000. Furniture, 50,000. And then cash to begin the business, 200,000, totaling 480,000. And this will be the initial investment that has to go in before there will be kebab. Otherwise, when you go there won't be kebab for you. Good. How he's going to secure the funding, that's not our problem now. But this is the money required. Okay. Now, we want to find out, operation-wise, how much is going to cost this gentleman to produce kebab. Okay. He's saying that cost of goods sold for 100 sticks per day. So his business, the capacity, that's the capacity utilization, is 100 sticks per day. That's what he can produce, or he's producing. The meat for one kebab is what? 1 ounce. You know 1 ounce? You know 1 ounce?
Yeah, sure.
Okay. So now we are using the metric system. So we, some of us we've forgotten the British system. You remember the 1 ounce, the ounces? How many ounces make 1 pound? Or how many?
1 gram.
16 ounces.
It varies. 16 ounces. Yeah, make 1 pound. Are you saying what? It's fluid. No. We used to calculate everything in ounces and pounds and then stones. You remember stones? I think 14 pounds, 1 stone. They are still using it, right?
So 16 ounces
a pound. Yeah, and then 14 pounds is 1 stone. Right. A stone means a stone.
But we are now doing grams.
Okay. So in our case, it will be grams. So you can think in grams.
In grams.
In grams.
1 gram.
That's the one. Right. But we are having how many kebabs? 100 kebabs. Okay. And each one, that's the meat alone, 1 ounce is costing 1,000 cedis. I think it's old Ghana cedis. So let's say 1,000 cedis. That's now it will be what? No, it will be 1 cedi. 10 pesos. Yeah. So that is it. So for the 100 sticks, the meat required will be 100,000. So he's calculating his cost. Good. And then the sticks. 1 is 100 cedis or 100. That's the old. Okay. So 100 will be 100 times 100, which is 10,000. Then the spices for 100, so much. Charcoal for grilling, so much. Labor per day, because we are looking at 1 day. So labor per day is what? 15,000. And then that will be the total cost.
License to sell.
Yeah. Well. Okay, assume that one is got it already. So our total cost is what? Total cost of 150,000. And the cost per economic unit or 1 unit of stick. 100 sticks, total cost is 150,000. So 1 unit will cost 1,500. And this is what we are determining the cost of goods that is going to sell. This is the direct cost. This is the direct cost. Okay. Then he's looking at the monthly cost. He's doing a lot. Advertising on local FM stations. That's for kebabo. Fire insurance. Okay, you will pay for insurance. Why is he taking fire insurance? Why is he taking fire insurance? Yeah, he's doing what? Charcoal. There's a high risk, so it's better to do fire insurance. So it's a lesson for us. Right. That monthly due to CMA. 20,000. Then the equipment that you've got, there's a depreciation aspect. And that one is what? 117 monthly. So these are part of the operating cost, but they are not direct cost. They are costs all right, but they are not direct. And so we have total monthly operating cost, which is 477. Good. This cost, some will call it more of what? A fixed cost. Okay. Good. So operating cost per stick will be what? 477 divided by our. This is monthly, right? This is monthly. A day was 100. A day was what? How many thousand?
106.
106.
Yes.
Okay. And then operating cost per stick. Okay. Assume operations is for 20 days per month. And then you divide by 20 days per month. So whatever is the situation, we are trying to calculate the unit cost per stick. Now, when we add the other one, if you remember the one that we got,
1,500.
that was 1,500. And then we add it to this one. The assumptions were 100 sticks of kebab sold per day, kebab sold 20 days. We have the 2,000 there. That's for the month. So now you want to sell. And the selling price is what? 2,000 cedis per stick. What's he trying to do? Let's see. Okay. Now, we move further. This kebab can, I think he's a serious business person. Wants to do the P&L. You not stopping at that. Now he has calculated per day. He knows what is going in per day, per month. Now he wants to do the P&L, profit and loss account, or the income statement for 6 months. From that's January 2013 to June 2013. 6 months. The sales is 24,000. I think when we multiply it, we will get it. Yeah, which is 20 days times. Let's look at how we are getting the sales figures. The number of days, which is 20 days per month. How many months? 6 months. How many kebab per day? 100. And what is the selling price per kebab? 2,000. So when you multiply all this, you get your sales. Is it difficult?
However, I still want to go back to the other slide. What did we do with the 1,523? How did it feature in the selling price? Because that was the fixed costs.
Plus the the fixed cost plus the direct cost.
The direct cost. The direct cost was 1,500.
Okay, we got what? 1,523.
This is the fixed cost.
This no, it was the fixed cost plus the direct cost.
Oh, the fixed cost is
That's the total cost of producing one kebab.
All right.
That's the total cost.
I missed the 23 cities.
Okay.
That's the fixed costs.
No. The fixed cost plus the direct cost.
And you are calling the operating cost the fixed cost, right?
No.
The operating cost are the same as
the operating cost is the fixed cost.
It's the fixed cost.
And then the total cost is the direct cost plus this one.
Okay.
And you are saying that how did it feature in the pricing?
No, I've got it. I thought the operating cost was 1,500.
Oh, okay. So you got it.
Yeah.
Good. And you know why the price is 2,000?
Yes.
Now the cost is 1,500.
2, 3.
And maybe looking at the market, one kebab is selling at that. Good. So this is what you got, and out of that, he wants to prepare a 6 months income statement. So we have to look for all costs we did for the 6 months. The first one, the sales. Sales for 6 months, we know per day, we know per month, we know the selling price. So you multiply 20 by 6 by 100 by 2,000, and then you have your 24. Good. Then the cost of sales. That's the direct.
The direct and the operating.
So the cost of sales, which is 1,500 per stick, times 2,000 per month, times 6 months, and then you get it, 18,000 or 18 million. From this one, you can calculate your gross profit. You just strike the difference. Okay, are you okay with that?
Yes.
Good. Now, once you get the difference, so we are making a gross profit of 6 million. And then from there, we calculate our gross profit margin. This gross profit margin, this is it, which is the 6 million divided by 24 million multiplied by 100. And then you get your 25%. So the guy will be laughing all right. Okay, we move a step further. After our gross profit margin, we come to the operating expenses. The operating expenses. the other fixed cost, which is 477,000 per month. But we are doing it for 6 months. So we multiply by 6 and we have that figure over there. You know, we were saying that we need to calculate how profitable is our company. How profitable is this company? Now we are taking 2 levels of profitability. Now the first one is we are looking at our gross profit margin. We know that this is the gross profit when we take all the sales that we've done and we take the direct cost, that's the raw material, the labor, what goes in directly. We subtract and then we get this 6 million. Good. But what is the percentage out of the sales? This 6 million is what's the percentage of this out of the sales? So the 25% is just dividing the 6 million here by 24. And then you multiply by 100. Okay. Good. So that one will tell me that my profit margin is 25%. And then is it good or bad? And that one will depend on the industry. It depends on your companies. What you may even have target. Okay. Then the operating expenses. You remember we had the expenses per month. Do you remember that? This 477,000 total monthly operating cost. This is what we are multiplying by say 6 months, because it also costs. So we multiply the 477 by the 6 months. Good. That's where item 4. So once we get it's a cost, so we just have to subtract this one from our gross profit. And then we get this earnings. Some will call it profit before taxes. We are using profit, so let's call it profit before what? Taxes. Okay. You say that we should add 3 and 4. The reason why we are adding this and this is that this has already been negative. I mean, it's just a minus because it's a cost, so it's a minus. We add and then we are getting 3,138. And then there's a tax component. What is your tax component? How much do they tax you? What's the tax rate? 25%. Yeah. So we are applying the.
What is it times 5?
This is 5. Number 5.
Times 4.
Yeah, just times number 5. No, it's not. So it's just the 0.25 is actually 25%. So we've earned so much. This is our profit. But government wants to take some so that roads can be built, so that hospitals can be built.
So why they can be built? They never do.
They are doing something. They are doing something. So we multiply the rates by our earnings. So this money that you have here, 784,500. We have to take it out of our profit at this point. So when we take it out, we will get this amount, which will be our net profit. This money, it has to go to government. And at times we refuse to pay. We refuse to pay and then they are on our neck. Yes, and they can close down our business. Have you seen the tax people closing our businesses? Yeah. They do that. They do that. Yeah, we shouldn't joke with them. In fact, they come with heavy padlocks, you know. Okay. So we can calculate our net profit margin, just like this one.
Just a little comment on the tax.
Okay.
There are ways of reducing tax without evading tax. Okay. There are professionals who will help you to manage that. One example is that if your factory is located outside Accra, Greater Accra region, you pay a lower rate. If you are in the agribusiness, depending on the sector you are operating, you pay a lower rate. If you are listed on the stock exchange, you pay a lower rate. So there are things that you can do to pay a lower rate. But after the business plan, you can begin to talk to your financial manager. on ways without evading tax.
And that's one of the reasons why there are some factories located just close to Accra, but near in some. You see? Near in some, close to Accra, but not in Accra. So they benefit from what Larry just said.
I have a friend who told me when he's getting to the end of the year and he's preparing his accounts, he realizes that the margin seems maybe very huge. At that time, he purchases certain equipment, certain things he should have done in the year that he didn't do, so that the net profit will reduce. Will you call that tax evasion or?
I think you have to be careful. Because when you buy equipment, it does not directly feed into your tax system.
Right.
It goes in your profit, it goes through the depreciation. But there's something that we call capital allowance, which they will add back. They will take the depreciation and then add back to the capital allowance. That reduces your tax. But you have to balance it very well because you use cash to buy. Okay? And you may want to evade or reduce taxes, but you will be short cash. So you have to be careful you have a balance. But it's a strategy some people use. What will you do for the capital allowance? What kind of? In the US, they will call it depreciation, tax depreciation. In Ghana, we call it capital allowance. In Ghana, if you use straight line or reducing balance for depreciation, the government will not allow that for tax purposes. They have a way of calculating that. So they will add back your depreciation to your profit. And then they will use their method to calculate and then take that one out. What their method, what they calculate is called capital allowance. In the US, it's the same. You have the depreciation. Just the one method is preferred. You understand?
Okay. You remember the ratios that we were talking of? That here, what we're discussing was the profitability ratio to indicate whether your business is profitable or not. And we basically use the net profit margin, a gross profit margin to determine whether this business is profitable. There are other ratios that we calculate, and for lack of time, liquidity ratio is also a set of ratios that we calculate. You know, at times you tell your friend, hey, hi, how is it? Are you liquid today? What's the meaning? When you tell, are you liquid today? You have cash. And that will tell us that there's a difference between profitability and cash. The liquidity actually helps us to know whether we have cash to pay our expenses, let's say within this year. That one we use our balance sheet. Okay? We use our balance sheet, which I think we'll see if we can prepare it. But when we look at the balance sheet, there are some figures that we use. Those of us who are familiar with balance sheets, we know basically we have what? If you look at the balance sheet, you have your current assets, right? And then you have what? Your fixed assets. Okay. Plus this one, and let's say your liabilities. You have your what? Two types of liabilities.
Current liabilities.
Current liabilities, and then long-term liabilities are called LL. And then we have what? Your equity and what? Shareholders contribution. Okay, let's call it equity. Okay. There's a basic equation which some of us may be familiar, others might not be familiar. When we add our current assets to our fixed assets, we'll get our total assets. And then current liability plus long-term liability will give us what? Our total liability. Let's call it total liability. And when we add our total liability to our equity, let's say we get what? Total liability plus, let's say, equity or shareholders' contribution. Now the figure that we get here, let's say this one is B. And then total assets here is A. Okay. Our balance sheet. This is our balance sheet. For a period. Let's say assets. December 2013. Our current assets plus our fixed assets is A. Then our current liability plus long-term liability, we get our total liability. We add equity, we get our B. A and B should always be the same, for the simple reason that all our assets which the company owns should be financed by somebody. Somebody should put in money. It is either we are financing from current liability, because if you go and you buy raw materials and you don't pay, it means the one who is selling raw materials is financing you, right? And you can go for a short-term loan, working capital. It's a current liability. You have to pay within a year. It is financing you. Long-term loan, some of us may have it. And then equity, what the owners put in, is also financing these assets. So we look at what we have in the business and what is financing that. They should be the same. That's why, you know, the accountants say should balance. And the term balance sheet, it comes from that. Okay. We use this current assets and then current liabilities. When we say current assets, it means you have assets that are within a year, you either use it up or it will give you money. And the terms or the items, the elements of current assets, basically the ones that we know are cash. The cash you have at the bank, the cash you have in the business right now, cash or real cash. And then you have, maybe some people are owing you, which we all call the receivables. It's also part of the current assets. And then you have your stocks, which you think that within a year you can turn it. And that one is also what? A current asset. And then current liabilities, those that you owe and you have to pay within a year. Those are all current liabilities. Now, when you divide your current assets by your current liabilities, you get a ratio. You see, when you divide your current assets over your current liabilities, you get a ratio. And ratio can be more than 1 or less than 1. Let's say if you get a ratio of 1, it means that your current assets are just equal to your current liabilities. That's the meaning. If you get a ratio of, say, 0.5, what's the meaning? Your liabilities are more than your current assets. And if you get a ratio more than 1, let's say 2, that means what? Your current assets are more than your liabilities, current liabilities. Now with this 3, depending on the industry that you are in, some industries, if you have this ratio to be 1, they might say it's okay, but still, when it is below 1, I mean, no industry will really say it is good. No. When it is 2, some industries, they say, fine, it is all right. When your current assets divided by your current liabilities is 2, it's okay. The meaning is that within a year, when you have a ratio of, say, 2, it means that you will be able to pay all the liabilities based upon your current assets. You can pay. because your current assets are more than your current liabilities. So assuming you can convert your receivables into cash, you can convert your stocks into cash, then you can pay those who you owe short term, 1 year. If it is less, it means you are not liquid. You are not liquid. So when they come knocking, everybody is coming. The short-term people, they are coming. You will be hot. So there are other ratios that we can still calculate. We have the investor ratio. Somebody has invested in the business. At the end of the year, my friend, what is our position? What is the return on my investment? I put in so much. Let's say we put in 100 million into the business. What is the return on it? So somebody is interested in investor ratios. If I'm coming to invest in your business, I'll be interested in investor ratios. I'll be interested in the liquidity ratios. I'll be interested in profitability ratios. Because it will help me to take a decision whether to invest or not to invest. So these ratios, they help us to analyze our businesses, and others also can have a good look at what we are doing. Efficiency ratios are also calculated. You see, you have various assets. This asset, is it really giving me the right thing? Is it delivering? Is it efficient? The break-even analysis, which I think some of us, who knows how to calculate the break-even analysis? You cover your fixed cost. Okay. Right. Okay. So if you are selling at this particular point with this fixed cost, you are covered, but you are not making profit. Good. You are not losing. You are not making profit at that point. So if you want to make profit, then something should happen. You have to sell more. Okay. So how do we determine it? Determine monthly fixed cost. This one I was trying to look at per month. Then you determine your variable cost per unit. And then determine your selling price per each stick of kebab. Determine the contribution per unit. That's revenue per unit. Okay. We know the one that we did. We determined the variable cost. That's the direct cost. The variable cost, the direct cost. It means that the cost that will vary with production. There are certain costs which will not vary with production. For example, what? Rent. It will not vary with then even salary of your administrative staff. It will not vary with production. Maybe you are engaging contract workers. If they produce, you pay them. That will be variable. If they don't produce, away. So those costs, we will call them variable. And then our monthly fixed cost, those costs that will not vary with production, we call them fixed costs. We will do that, and once we are able to calculate all these costs, we'll be able to determine our break-even point. So let's see what has to be done. So we need to determine our total monthly fixed cost. You remember the calculation? It was 477,000. And then the variable cost per unit, that's the direct cost, was 1,500. And then the selling price was what? 2,000. The difference between the selling price and then the variable cost per unit is called, we call contribution per unit. The sales portion, which is contributing towards what? The fixed cost. Because we want to cover our fixed cost. So we have to know part of sales which will contribute to our fixed cost. And it's just 2,000. That's our selling price minus our variable cost, and we get 500. To determine our break-even point, it is our fixed cost, monthly fixed cost, which is 477,000, divided by this contribution. So this person who is selling kebab should produce 954 sticks per month as break-even.
His target was 100.
2,000. A month was 2,000.
2,000 pieces.
The target was 100 per day. 100 per day.
Okay.
And he was working for 20 days. So a month was 2,000. But the break-even is if he's able to produce and sell 954, break-even. Anything more, profit. Are you okay? I think this is what we can calculate.
And then there were some assumptions.
Okay, so I think
all these assumptions.
But they can sell a maximum of 6,000.
and then starting from when? January 2015. We are supposed to develop it. Inflation rate of 15%. The medium term outlook indicates a little or no change in the rate. Something of tomato paste weighs 100 grams and the cup.
That is
and 1 year we multiply by 12
For the year, so we do it 1 month times
12 yeah
Per 10. Yeah, so the cost per 10, that's 200. And then the cost per gram of tomato is 0.005. So if we need the cost per... I don't see the cost of packaging here, though.
it says the packaging labeling is 0.10.
Alright, so the cost of tomato, so per 10 is the point. Is that figure you got?
Yes.
You can use it for
So it's 100 grams of paste in a tin.
So that's when the conversion is. Okay. So to produce a tin, what goes into it?
Just for that year 3, year 3. So you look at all these investments and list the items, you have the investments which will be made in a particular year.
So this is simply to arrange them. I think the finance bill will...
Because if you look at the items, you're going to buy, there's a factor.
Inflation, but then when we get that figure, then we calculate the inflation. So we have all these figures, then we can fix them into the spreadsheet. So we first state that our sales, the figure of what?
We are selling 6,000.
No, we are talking about the units that we are producing per month.
Okay. Yeah, that's it.
Okay, so
Each tin.
But if you look at the production, packaging and labeling costs 13, tomato is 10, so you have to add the 10 pesos. So now you
It's very challenging. Okay. How do you find it? It's tough. Hey, you know. Right. Okay. And also, it helps you to appreciate these numbers. And when we say financial statements, they don't really come from the air. It's come from the operations, what we are doing, that we can get these financial statements. Good. So what was the rate? Year 1, it says that the rate of depreciation from, before you arrive at this, there might be something. You did your research. You talked to the economic gurus, or there were publications. Bank of Ghana has made some projections which you are aware of. And based upon that, you had these assumptions. That it will depreciate by 10%. 15%, year 1, year 2, 10%, and then what follows. Okay. The way this has been done, like you need to know a little bit of Excel. Because some of the calculations, once you see the rate and you want to calculate the, you have the rate as 2.8, in the first year. When you go to second year, there's a calculation which has been done, but you need to know a little bit of Excel. Otherwise, you might use the ordinary calculator and then papa, and then you put it there. It is acceptable. You have put your rate there, all right. But what happens is that if there's a challenge and realize that no, the rate is too high or too small, can it be changed? Then when you change it, then immediately it has to affect it. Otherwise, you need to go back to your calculator and then do it, calculate it before you put it there. Let's just see how just one of them will do. Okay, so if we go to this one, this is given. This was known as 2.8. The rest were calculated based upon the rate of depreciation of the dollar. If we go to the next one, this rate. Okay. You mean? Okay. Look at what we see. D9. D9 is what? D9 is the 2.8. You know, in Excel, what is important is the rows and then the columns. They are used everywhere in Excel. So we don't joke with the columns. A, B, C, D, to go, we all know. And then the rows are here. So the D9... Don't confuse us.
Columns are vertical, rows are...
Oh, right, okay. So we have the columns, we have our rows.
Solomon, John, Solomon.
Okay. Okay, now the formula says what? It's D9 times 1 plus E10. What is E10?
Rate of depreciation.
No, what's the figure?
10%.
10%. What is D9? What is D9? 2.8. Now, with Excel, it uses what we call relativity. Immediately, something happens to D9. This will change. That's how we set it up. And that's how, when you are practicing it, that's how you try to do. Let's say, instead of the 2.8, it's actually 3. So quickly, if I change this one to 3, let's see what will happen. Mind you, that one is 3.08. If I change it to 3,
and the next one is 3.3.
Immediately it has changed. 3.3. And then the other one has also changed. Yeah, because of the formula that was put in. So this is how all the calculations have been done to make it easier. Otherwise, you have to do a lot of... So you need to understand. But I think if we have a lesson in Excel, that's also different. But let's just go through it. So we've listed all the assumptions. Selling price will also rise by, I've given an assumption of 12% per year. In some cases, it might be more, it might be less, but for simplicity, this we are using for simplicity case. Okay. And then fuel prices, that one was given as what? 20% per year. And then cost of raw materials and packaging, we've given it as what? 15%. Well, maybe the reason why the person realized that the cost of raw materials is just close to inflation rate. What was the inflation rate? 15%. Do we have it here? Yes, it's here. So inflation rate was 15%. So inflation is basically increases in prices. So the raw material was maybe equal to the rate of inflation. And then we have the other. Utility prices is given as well, 25% per year. Okay. And then we have it over there. Then when we come to operations, there were some assumptions. Installed capacity was what? 12,000.
12,000.
That's the machine has been made to produce 12,000. But that is at what the factory gave. But actually, you might not be able to produce that. You gave us that the capacity utilization, the maximum was what? 10,000. Which means that you cannot produce more than 10,000. So if you're... no, the 10,000 is throughout. So we cannot produce that. Then there was another one, that operating capacity or capacity utilization. For the first year, your maximum was what? 6,000. And then we have that 6,000 over there, down there. Yeah. Right. The capacity. Yeah. Sale is 6,000 for the first year.
So, can you explain the difference between the installed capacity and the
Capacity utilization.
yes?
Good. The installed capacity is you have the machine when it's coming from the factory. It says that this is what this machine, if you install it, this is what it can produce. But when you are producing, there are downtimes. At times, you may have lights off, which will affect your capacity.
And there are inefficiencies.
Inefficiencies in the machine.
Yes.
Wear and tear will happen.
So it slows down.
Right, it will slow down a bit. So you have capacity utilization.
Question. The maintenance and repairs each month.
Yeah.
So do those go into your direct costs to actually produce since they are so frequent, or do they end up being on your indirect costs?
You add it to the indirect.
Indirect stuff, even though it's that frequent and so tied to your operations.
Well, the issue of the direct and the indirect at times is tricky, but whether that cost is actually is directly affecting operations. If it is a major cost, fine, but for this one, we will just treat it as indirect. Okay. So we have I'm assuming that if in year one you can sell only 6,000, then I will not produce more than 6,000 because I want to sell everything that I produce. Then the following year, I increase my operations to 7,000, 8,000. But there should be reason for increasing it. There should be reason. Maybe your market is expanding. You are spending money on marketing, and you might expand. Something might happen that you need to produce more. That's why you have the figure increasing. Then we had this weight per 10, which we were given, and then conversion rate. What is conversion rate?
There is the commodity can sell a maximum of 6,000 tins per month during the first year.
Yeah.
Of operation. How is that? And you didn't finish explaining. You jumped to the maximum utility capacity of the machine.
Okay, they are related. What we said was that the installed capacity, that the machine is 12,000. But then the capacity utilization, what we can really produce is 10,000. That's the maximum. It's now for the first year per month.
For the first year.
Yeah.
Is 6,000.
Good. So I'm assuming that that's what I can produce during the first year. Every month. Yeah, per month. Every.
10,000. 6,000 per month.
Yeah. Let's go on. Good. Thank you. Then we come to a conversion rate. It's 50%. I hope we understand conversion rate. Those who are into production, you are buying tomatoes. Tomatoes.
Buy 1 kilo.
You buy 1 kilo, and then you squeeze it out. You get only 50%. So if you buy 100%, you get only 50%. So that's the conversion rate. Okay. Look at the relationship. The price of tomato was set to go at 5. No, the price of tomato per kilogram was 5 cedis during the first year. What about the second year? You know, cost of raw materials and packaging is going to increase by 15%. So I have to use that assumption to calculate the next price of tomato. So that is what we have, is D28, which our D28 is the price for year one multiplied by the additional cost as a result of inflation or the increase in price, which is 15%. And that's how we did it. E13 plus 1, and then you get the new price. Quickly, let's look at our investments. That's another sheet that you have to create. You give it various investment figures, right? Quickly, I'm assuming that we are going to start production in year 1, 2015. But I have to do the investments before. You see, I have to do the investments before. I'm assuming that the year of investments, I'll call it year 0. Right? Maybe from right now, I'm doing the investments, I'm doing the installations, I'm doing that. Let's call it year 0 before I move in to year 1.
So even if it takes you 2 or 3 years,
well, you can
all together in 1 year.
No, in that case, you need to adjust it, and then because they might have implications. Okay. So what are those things? These were all mentioned. They were given. The processing equipment was what, 80,000. A vehicle, office furniture, computers, water tank. But then the working capital bit was not there. So let's forget about this working capital. It wasn't part of it. But I created a space for it because I will need working capital. It's a form of financing. I will need finance to finance my working capital. So I will need money. So I have to determine what working capital will I need when I'm starting the business. Okay. Once I've got my total investments, I have to finance these total investments. Where would the money be coming from? What I have here, that one you have to decide. I gave you only one option. What was it? That the loan that you can contract should not be more than 60% of your, it shouldn't be more than 60% of the total investment. That was it. So apart from that, you can do whatever you want to do. Okay. So with that, I need a loan from a bank or from somewhere, and that one, I had it as 59,000. I have a working capital loan, but somebody will say, how did you get all this? I started with this. Stated capital, owner's equity, initially what you put in, or when you register the business. How many of you have registered your business with the limited liability? So you have your stated capital. Good. And that is what I have over here as 20,000. And then you need additional equity capital, maybe by other shareholders. And that I estimated it to be 50,000. That one you can decide how to do it. Based upon that, the rest should be financed by a loan. You see that it's balancing. My total investments and my total financing are balancing. They have to balance in a way. Because whatever I invest, I need to finance it. Okay. So this is one sheet that I have to do. There are so many sheets that I went through. Depreciation, I think that one, we've talked about it, so we will not bother ourselves. I have to depreciate all the assets. You remember, some were given 5 years, some 20 years. Okay, I assume if we assume that, for each asset, as I explained, maybe I have to depreciate it by 20%, or it's for 5 years, then it has to be 20%. So I need to do a depreciation for each asset. Okay. Why am I doing it? Because it's part of my cost. It will feature somewhere. At the end of the day, when you finish with your depreciation, you have to come up with your book value. I did it for all the assets, and this is what I got for the total assets. This one was for first year, this one second year, and this one third year. These figures will go into the balance sheet because that's the remaining of your assets. And we know that our assets will go into our balance sheet. So these figures, year 1, this will go. Year 2, the next one will go. Year 3, the next one will go to the balance sheet. Okay, but the depreciation expense, where would it end up to? We said it's a cost. So eventually, it will go into the income statement as a cost. Okay, and it will feature in the cash flow as well. But let's maintain it that way. Another thing that I did was profit and loss. But before the profit and loss, there's a cash flow, there's a balance sheet, which we are supposed to do. But this one, let's try and squeeze this a little bit. We can see. Yeah. Okay. This is what I did for my sales projections, my revenues. For simplicity, I'm assuming that there's no seasonality.
All right.
I'm assuming that I'm producing 6,000 per month. But in reality, there will be seasonality, even for tomatoes. You cannot really get tomatoes all year round, unless you combine Burkina Faso, Mali, and whatever countries. Or maybe you bought some.
You use greenhouse.
Okay, somebody said with irrigation. So there will be a way. Okay, good. So let's assume that you get it. So that one, the sales revenue projections is one of the easiest. I know what I'm producing. I know the price was given as 2.5. So quickly, what do I do? How do I get my sales? How do I get this one? Okay. This is just a sum, right? But the actual figure which I need, this one, how do I get it? Good. It is just the quantity I produce multiplied by what? The selling price. And then I'll get my sales revenue. So I'll do it for every month. And I'll get the total. If there are other incomes, I may add it, I'll add it to it and I'll get the total revenue. Okay. This is for year 1. We can go on. You see, there's year 1 total, and then year 2, and then year 3. That one I don't have the monthly, but I have the total. So I have year 1, year 2, year 3. And this is what we have to do for all the others. So the sales revenue is important. And then the production cost. Okay, we need to go through that one too. Okay. Good. The production cost. Good. We have the installed capacity. We have the operating capacity. I have the volume of raw materials required. You know, I need raw materials. I need to calculate my raw material cost. But what is it? What is the volume of raw material that I will use per month? If you do the calculations, you realize that you need 1,200 kilograms, which is 1.2 tons. If you do your calculations, you get 1.2. Well, anybody who got that one? You got it? Good. So when you do the calculations, tomato that you need per month is 1.2 tons or 1,200 kilograms. And we know the cost of what? 1 kilogram.